All right, so we are now jumping into equity securities. And so we're going to kind of, again, not move too quickly or too slowly, but, sort of like in class, I think I kind of went at one pace. Here, I'll probably go at a slightly slower pace so that you're able to kind of review and kind of bring in as many details as you want. So when we talk about equity securities, very quickly, the basically four events that we need to focus on or potentially need to include in our transactions. One is when we purchase the equity security. Two is receiving dividends. Three, we're going to hold the equity security, so that's going to create gains and losses. And even for some methods, those gains and losses might be met based on net income. Others might be based on changes in fair value. And then obviously at some point we're going to sell the investment as well. And then the way we classify equity securities, rather than being based on intention, is based on level of influence. And so we talk about level of influence. Really, there's three categories that we have. One is called passive investment, and basically, if you hold less than 20% of the outstanding stock, you're deemed to basically not have any significant influence over the investee. And so you're going to use what's called, fair value adjustments. So you're going to just look at the fair value. You're going to make adjustments based on that, recognize gains and losses as the share price changes. It's a pretty straightforward, pretty easy process. One that's a little more complicated, but not too difficult, is when you have significant influence. And so that's when you own 20 to 50% of the voting stock. And so that situation is one where basically, you're not holding it passively. You're actually trying to influence decision making. You're holding it for reasons other than actively trading those shares. And so you're going to use a different method, and that method is called the equity method. And really what that focuses in on is changes in the book basis or the book value of those shares. And so rather than in the passive investments, you're focused on market value. With the equity method, you're focused on the book value. And then finally, and this is one we're not covering in this class, is if you own more than 50%, which would be like a controlling interest. In that case, you do a consolidation. And that's something, at least here, that we cover in the Mac program. We don't cover that in intermediate accounting. And so we're going to start by looking at passive investments. Again, this is less than 20%, no significant control over the business that I've acquired shares in. Very similar to debt securities or trading debt securities, and that we do these fair value adjustments. The nice thing is you don't have to worry about amortization and all that other kind of stuff. You're just looking at the share price now versus when you purchased it. And so you will have gains and losses, or they call them unrealized gains and losses, as you make updates to that. Usually at the fiscal year end is when you do that. And so these changes in the fair value do get rolled into the net income of the company. And so as an example, we purchased 10,000 shares of Apple stock for $85. There's a dividend payment, then there's a change in the price by the end of the year. We sell some shares, another dividend payment, and another change in the price. So you can kind of see the rhythm of where these go. You basically make a purchase, go to one fiscal year end, have some transactions, go to the next fiscal year end, and off we go. And so we're going to do the journal entries for 25 and 26, and we're also going to include financial statement effects for those 2 years as well. And so first of all, looking at the April 10th, 2025 purchase, pretty straightforward. You just take the number of shares times the price per share. That amount, that 850,000, that ends up being the debit to the equity investment. And of course, that's offset by the credit. That's how much I paid. And now they're just on our books at $85 per share. Dividend payment, there's sort of like an easy part of this, which is that I received $1.50 for every share that I hold. And so at that time, I held 10,000 shares. And so I'm going to receive $15,000. So we're going to debit cash 15,000. And then because this is a passive investment, that dividend is considered dividend revenue. So in other words, the share price is changing, but I'm also getting a dividend. And so that dividend is additional revenue. And so notice that it's a revenue account for that same amount. And then at the end of the year, you got to do what's called the fair value adjustments. And so, of course, the price of the equity investment changed. And so we're going to reflect that and flow that change into our income statement. And so very similar to what we did before, and sort of like going as a sort of a step-by-step kind of a process. And so we start with the fair value per share, and at the end of the year, it was $102. We compare that to the original cost, which was $85. Notice it doesn't say amortized cost because for an equity investment, that original cost never changes. It just stays at $85 per share. That gives us a balance per share. In this case, that balance is $17 per share. It's a brand new investment, so there's no prior adjustment balance to worry about. Therefore, the entry is just an increase of $17 per share times 10,000 shares, and that's going to be a debit to our fair value adjustment account. That debit is offset by a credit to that gain/loss account. Again, it is a part of net income, and that would be reported on the income statement. And then going into the next year, we sell 2,000 shares. It's a multiple step process, kind of like we did with the debt investments. Much easier though. Step one, we do sort of update by making a fair value adjustment. At the time of the sale, the fair value per share was $105 per share. We're going to compare that to the cost, which tells us an updated balance. That updated balance is $20 per share. We compare that to the prior balance of $17, which means the change is an increase of $3 per share. We apply that just to the 2,000 shares that I'm selling. Just to be clear, we only apply this to the shares that we're selling. And so we're going to debit the fair value adjustment account $6,000. So $3 per share times 2,000 shares. That $6,000 debit is offset by a $6,000 credit to our unrealized or gain or loss on investment, the unrealized gain or loss account. Again, that's first step. We're making that fair value adjustment. Again, we're debiting the fair value adjustment account and we're crediting the net income account. So again, that's the first step. The second step then is to basically record, taking those off the books and receiving the cash. And so the way that we redo that, again, hopefully the cash payment's pretty easy. We receive $105 per share times 2,000 shares. At the same time, we do need to remove that equity investment. Remember, the equity investment account is at the original cost. So we're going to remove them at $85 per share times the 2,000 shares. And then the difference then is the balance in our fair value adjustment account. And that balance we just calculated, again, clearly here, just to be clear, it's the balance in the account is $20 per share times 2,000 shares. And so that's an additional credit of $40,000. We just take that information and we put it into our journal entry. So now we're done. We basically now completed a little bit of animation error there. And so we've completed the sale of those 2,000 shares. Now we're just left with the 8,000 shares that we didn't sell. And so later on in the year, when we get that dividend payment, $2 per share. But again, just to be clear, it only applies to 8,000 shares that we still hold. And so that dividend payment then is $16,000. Again, debit cash, credit dividend revenue. And then another fair value adjustment. We come to the end of the fiscal year. And again, for those 8,000 shares, the share price changed. And in this case, the price per share is $99 per share. We compare that to the cost. That gives us an updated balance of $14 per share. We compare that to the prior balance, but just to be clear, this is the prior balance for these 8,000 shares. We didn't touch that $17 per share amount for these 8,000 shares. We only changed it for the 2,000 that we sold. And so what that means then is that the change per share is a decrease of $3 per share. Therefore, we're going to credit the fair value adjustment account, $24,000. That credit is offset by a debit to our unrealized gain or loss account. Again, hopefully not too difficult, something that you're familiar with. And so then the next step is to take that information and figure out what happens within our financial statements. And so when we talk about these passive investments, we're going to kind of look at 2025 and 2026. First of all, the equity investment account, hopefully it's pretty straightforward. It's just the cost of the shares times the number of shares that are being held at that time. And of course, it slightly varies year to year, depending on the number of shares that you still hold. And so that's the easier part of the two. The second account, hopefully that's something that you could have figured out, the fair value adjustment account. And again, we're looking at the balance on December 31st of each year. And so December 31st, 2025, the balance is $17 per share. At the end of 2026, the balance is $14 per share, again, with understanding that in 2026, there's only 8,000 shares. And so we do that math, that's what we would report for the fair value adjustment account. And then finally, looking at the income statement, we have the dividend revenue account. Again, we're looking at journal entries for these, because we're looking at changes to accounts. And so we'd focus on journal entries. And so the dividend in 2025 was 15,000. The dividend in 2026 was 16,000. And that's just what we report as part of our dividend revenue, noting that it would be reported under other income or loss. And then the second thing we have to worry about is those fair value adjustments. And so there's gains and losses as part of net income. In 2025, the only thing we had to worry about was the December 31st entry. In 2026, we had the sale on May 1st and also the December 31st journal entry. Notice though we had a gain on May 1st and then we had a loss on December 31st. So we net those together for a net loss of $18,000. And so that's what we would report as part of our net income. So again, we'll stop there. That kind of covers passive investments, and then we'll do the next lecture. We'll look at the equity method for equity investments.